Hello, everyone, and welcome to the Traction Financial Partners first quarter of 2026 market and economic recap video. We're recording this on April 14th, 2026. My name is Drew Barnes. I'm the Director of Financial Planning here at Traction Financial Partners, and I'm with our CEO and founder, Bob Heykoop, who will be joining me. And we're just going to cover how the markets performed throughout the first quarter of the year so far. We are going to start with equity markets overview and how the various indexes and areas of the stock market has performed. We'll then go into the fixed income or bonds and key interest rates, and how they're performing and where rates stand after the first quarter of 2026. We'll then go through some economic information as it relates to inflation and the labor market, as well as addressing the oil and energy markets. And then we have a handful of information on the on markets and just doing some things to help kind of put where we stand in perspective. So with that, I'm going to go ahead and turn it over to Bob, and Bob's going to take us through the equity markets.
Hello and welcome. It's been an interesting quarter in the markets, to say the least. As you can see, we've had a very good week. This was through Good Friday, April 3rd. Every one of the major indexes was up, led by the S&P 500 or the NASDAQ and the S&P 500 had a very good week. Year to date through the third, the Russell was down 9%. NASDAQ was down 5.71. The S&P 2.53 and 2.83 respectively. It's amazing what 7 days of trading does. As close of business today, we're actually up on the S&P about 1.5%. Historically, if we look over at the far right column, you can see the NASDAQ has led the major indexes over the last 3 years, followed by the S&P 500, which is a much broader stock index, and the Russell 1000 growth. This is probably no surprise if you have bought any type of fuel in the past quarter. Energy, since our conflict started in Iran, energy year to date is up 33.5%. A distant second to that is raw materials, followed by utilities, consumer staples, industrials, and real estate. And again, this was through Good Friday the 3rd, when the S&P was down 3.5%, healthcare was down 4.7%, communication services 5.5%, technology 7.4%, technicals and consumer discretionary trailed everything else that first quarter. If you've listened to any of our market and economic updates in the past 5 years, almost every one of these, we've included a conversation about the Mag 7, or those 7 largest capitalized companies: NVIDIA, Meta, Tesla, Amazon, Google, Microsoft, and Apple. 2022 was a pretty difficult year in the market, as you can see. But the last 3 years, 23, 24, and 25, the Mag 7 made a significant contribution to the overall return of the market. In 23, the S&P did 24%. 76% of that return came from Mag 7. The other 493 stocks in the S&P 500 provided 11% of that. In 24, it dropped off a bit. The Mag 7 provided 48%. while the 493 stocks remaining in the S&P gave us a little bit larger portion of our return of 14%. And then last year in 25, the Mag 7 dropped all the way down to 23% of the return with 13%. The rest of the S&P for a total return of 16. Very interesting start to 2026. At that point, the S&P was down 5%. The rest of the market was down 1%, and the Mag 7 was down 11%. That very bottom line shows the percentage share of the return. So it's critical to understand when we see markets move, how much impact those 7 companies provide. In the lower left-hand part of this slide, we all know that earnings make the difference in the market. And when we're seeing companies that are being profitable and churning out these earnings on a regular basis, the price and the return of stocks tend to follow. In 21, the Mag 7 had an incredible year where they had 60% earnings growth. The rest of the S&P 46. 22 was our down year where the Mag 7 had negative earnings growth of negative 14%. The rest of the S&P 9%. In 23, the Mag 7 bounced back again, was profitable, and we saw those earnings grow by 31%, where the rest of the market actually was negative just 4%. 24, again, we saw the Mag 7 earnings growth surprise a lot to have another year that grew as much as they did at 40%, with the rest of the S&P lagging with only 4% earnings growth. Last year, again, we saw a pullback. The earnings only grew 22%, where we got some more contribution on the earnings side from the rest of the S&P. Then so far in this first quarter, earnings that have been reported from the Mag 7 are up 26%, and the rest of the market 14%. So price to earnings ratio, you hear the talking heads speak quite a bit about multiples of earnings and the market being overpriced. Let me draw your attention first to the long-term average back to 94 of the S&P 500, the earnings ratio 7.2 times is the long-term average. The one standard deviation from that is the next green dotted line, 20.5 times. If you look at the standard deviation below that, the bottom green dotted line, 13.9 times. So you can see that literally since COVID in 2020, we've had a couple of peaks where the market has been overvalued. We've seen some troughs where the market has been undervalued. Most recently, at the end of 2025, again, overvalued, and now it's down below that one standard deviation at 20.5. So that's something we keep a close eye on as this moves, because this is critical to understanding the yield that we're seeing on dividends of dividend-paying companies in the S&P 500. Now we're going to talk about the little bit more boring side of the market, fixed income, and the bond market and what we've seen here. I'm going to start all the way over in the right column. If we look at the U.S. aggregate bond market, the 3-year cumulative return is almost 11%. So bonds are back to performing very close to their long-term average. Corporate bonds have outperformed that almost 14.5%. Municipals, 8%, and the high yield side of the bond market, 28%. So the 3-year cumulative return in bonds has been good. We look at year to date, it's been relatively flat. You can see we have all negative numbers, but they're not down significantly. And over on the far left column, we can see what they're yielding. So understanding the difference between the broad bond market of the aggregate at 4.6, U.S. corporates a little over 5, municipals right around 3.5, and high yield at 7.5, which is their current yield. As we look at the key rates, and these are followed closely, and we think quite a bit about potential changes coming this year with a new Fed chairman. What's the Fed going to do to the rate? As they look at this, with the conflict going on in Iran, I suspect that things are going to stay pretty benign for the rest of this year. Don't think we'll see a reduction in rates by the Fed, and probably not an increase either. If we look just through the third, U.S. Treasuries are yielding 3.84. 10-year is at 4.35. The 30-year, 4.91. The 10-year German bond at 3. The SOFR at 3.65. The 3-month Euribor at 2.10. The current 6-month CD rate is now dropped below 2, which is down a bit from a year ago. The 30-year fixed mortgage, which many of our potential home buyers are watching closely, is at 6.5. And a year ago, that was just slightly higher by 1/4 of a point at 6.73. The prime rate, which is the rate that banks give to their best customers, and typically what most home equity lines of credit are tied to, that has dropped 75 basis points since a year ago. Always wanting to know what the Fed's going to do. We're trying to guess that. The market also is trying to anticipate that. What they are going to have as the federal funds rate. If we just look historically all the way back to 93, in 2000, it went over 6. It dropped very quickly to below 1% in 2003. It popped up quickly again in 05 and 06 to just over 5. Then it dropped to pretty much 0 for a long run through the financial crisis and through 2015. Then we started seeing it creep up again to combat inflation in the years from 2016 through about 2018. Then, of course, we were hit with COVID, and the Fed drastically cut rates again down to 0. It didn't take long after that to have rates pop back up quickly, and we saw them get to a high in the end of 22, beginning of 23, of 5.25%. Now, what's going to happen in the future? The market is anticipating the federal funds rate this year at 3.62, dropping potentially with one rate cut down later this year to 3.39, and possibly just maintaining that for a while. The FOMC's year-end estimates, where those are tracking compared to what the market is expecting, are slightly lower. Now I'm going to hand it back over to Drew, and he's going to run through our economic update as well as some market perspectives.
All right. Thank you, Bob. So when it comes to the economic update coming off of the kind of expectations for the Fed, where the market no longer really expects any Fed cuts this year, while the Fed still projects one. Um, the Fed has what they call a dual mandate, which helps them set their interest rate policy. One component of that is inflation. So this is a chart of inflation going back to 2018 and the various components that we can see in the various colors here of what make that up. We can see the last time we had an oil spike similar to what we're doing now was in 2022. We had inflation going all the way up to 9.1%. What's important to kind of think about there is that if we see these green lines, that's the contribution from energy. So the contribution of energy was about 3%. And then the rest of the inflation was all these other components. And that's when the Fed had, effectively printed a bunch of money to take us out of the COVID recession. And so while energy obviously went up quite a bit, and we'll see on another slide here where gas reached 5%, energy itself really was only responsible for 3% of the inflation back then. So just keep that in mind as we move forward to today. We can see inflation has steadily dropped since then. As of the end of the first quarter on March 31st, we had only received the February CPI release. It was at 2.4% year over year. We've since had the March CPI, Consumer Price Index, released. And with the recent spike in oil and gas prices, it shot back up to 3.3. So, we're back probably the highest since we've been since spring of 2024 at 3.3%. Now there's another version of the CPI called core CPI, which strips out more volatile areas like energy and food, because those prices kind of can tend to swing around quite a bit. When you strip those out, inflation was at 2.6, so pretty solid. So, if you're wondering, well, hey, with oil prices and gas prices going back up due to this conflict with Iran, are we going to revisit, something like 9% in 2022? That's why I pointed out that energy really only equated to about 3% of that big increase. We don't have that backdrop this time around like we did of all the money that had been printed coming out of COVID that we had back then. So it's our belief that we should certainly see higher inflation as long as oil and gas prices remain elevated, but we don't think we'll revisit the highs that we saw back in 2022 because, these other components just aren't going to be inflating by quite that much. The other component of the dual mandate is the labor market. And so, what we have here is various data points for the labor market. If we look at job openings here on the left-hand side of the screen, we can see that things really shot up after COVID. Again, businesses received a bunch of cash for various programs that were put in place to rejuvenate things from the COVID shutdown. And we've steadily been falling since. So we can actually see now with this blue dot, if we kind of go back, we're back to where we were in about 2018 in terms of job openings. So nothing really alarming at this point, but much more normalized compared to where we have been the last several years. Top right here, we're looking at hires. Hiring is at its lowest point, if we look here, dating all the way back to about end of 2013, early 2014. So job openings have fallen quite a bit. They're still at a fairly healthy level, but companies just really aren't hiring much right now. If we look at the bottom right, layoffs have kind of steadily increased since the low coming out of COVID, but they're kind of back to that longer term average of where we were from about 2010 to 2019. So not a lot of layoffs are happening here either. So I've heard this referred to as the no hire, no fire economy. where our labor market is really just kind of remaining static at this point. So nothing alarming, but we're keeping a close eye on this because if the firing or the layoffs start to pick up, then this could cause for the Fed to take action and lower rates and things like that. Okay, so the big topic right now with this conflict when it comes to the economy and everyone's feeling it, as Bob mentioned, when you're pulling up to the gas station, is we're seeing much higher prices as it relates to commodities and energy. So we can see here as of the close of business on April 3rd, that oil had shot up all the way to over $111 a barrel. Whereas we ended the year at $57 a barrel. So that's nearly a 100% increase right there. And then a year prior, we were at 67. So we'd actually made really good progress. We'd come down from 67 to 57. And then we've shot back up throughout this conflict with Iran. Where we stand today, we're actually closer to $92 a barrel on WTI, West Texas Intermediate. Which is U.S. oil. So we've come back down about 17%. So that's a welcome sign, and I think it's really just going to depend on how the conflict unfolds from here. But obviously, we're keeping a close eye on that. That goes straight into gas prices. So the national average right now is about $4 a barrel. Coming into the year, it was about $2.81. So obviously, we've seen a big increase there. And then just some other things that we keep an eye on in general are some precious metals. Gold has seen an increase so far this year. It was actually up, I believe, near 5,400 at one point. So it's come down kind of counterintuitive to what you'd expect during this conflict, but it has come down, but still up on the year and up an awful lot from where we were a year ago. And I think that's just cool. Looking for a place to put money where cash is not as appealing as it once was. We've seen a big jump in silver. It's about flat on the year, but it's more than doubled where it was a year ago. Silver has got some components to it like gold from a safe haven perspective, but really it's used a lot in the production chips and data centers for AI, as is copper. So we've seen big jumps there. So in general, we've seen a big jump in energy. And that's going to kind of be the major consideration for the Fed and what that means for inflation as we move forward. Now, just again, the impact of what oil really means to the U.S. economy. Retail gas prices, see each of these colored lines represents a year going back to 2022. 2026, where we are is on this orange line, is we're mimicking a lot of what we saw in 2022 so far. We're higher than we were at any point in 2023, 2024, and then we can see the green line, 2025 of last year, where we hung out between $3 and $3.25 for almost the whole year, shooting below $3 near the end of the year. So obviously, we'll see if this trend continues. We're hoping it doesn't resume its march higher like we saw in 2022. What does that mean for the economy in terms of things like GDP? Well, going back to 1967, we can see the percentage of GDP of U.S. net imports of petroleum and related products. So obviously, it spiked quite a bit during the 70s and early 80s, came back down throughout the rest of the 80s all the way into the early 2000s, shot back up. And then has kind of steadily come down. You can see as of the end of last year, we're actually slightly negative, which means we're actually net exporters. So higher energy prices from a GDP perspective is pretty neutral. If anything, it might actually increase economic activity because we are now net exporters. What does it mean for consumers? Well, like most things, it impacts the bottom income cohort the most. So the bottom 20% as a percentage of total income by pre-tax income, this is in 2024, they're still working on the 2025 data, 17% goes to these types of energy costs, whereas 20 to 40%, the bottom 20 to 40% of income earners close to 10. And obviously, as income goes up, it starts to slide down to the top 20% of earners, less than 3% of their budget or of their income goes to these expenditures. So clearly, it's going to put a much bigger sting on the folks at the lower end of the scale. So, obviously it's something we're keeping a close eye on, and the longer that those prices increase or remain elevated, it's going to really start to put a strain on the lower income earners. Okay, so what does all of this mean in terms of keeping things in perspective as investors when we look at where we're at today and moving forward? So US equity returns during oil price shocks. So since 1970, there's been 8 periods where the price of oil has increased by more than 50% without a monthly decrease. Um, so we can kind of see right now, obviously, we're at this current spike. So what has happened in these past periods? So we can see these 8 occurrences, what the overall increase was in energy prices during those times, and then the intra oil spike return. So you can see during this initial spike, it's a pretty mixed bag. You got down 10% for the market, up 10%, down 14, up 4. During this current stretch, we've been down 4. What do things look like 1 year forward? Well, we can see, with the exception of 1 year, which was the oil embargo of 1973, so a little, kind of a totally unique situation there. The other 6 periods, we don't know where we're at currently, obviously, a year out, but the other 6 periods, the lowest 1 year performance we saw was up 13%. So historically, equities have actually done pretty well once the oil spike comes to a conclusion. Okay, and of course, what is driving this oil spike? It is the military conflict, the war with Iran. And we put this chart on the screen just to kind of put things into perspective. So maybe it might be interesting if you pick out the year where you were born and see all the various conflicts that have occurred since then. But if we go back all the way to 1928, we've had all of these various conflicts, obviously ranging from world wars to the Korean War, Vietnam, the first Gulf War, Afghanistan, Iraq, the Israel-Hamas conflict that started a few years ago, Russia, Ukraine. And what we can see is and this is a logarithmic scale, which is important to point out. So it goes from 1 to 10, 10 to 100, 100 to 1,000, 1,000 to 10,000. So where the index level of the S&P started at, we'll call it 20 over the course of this nearly 100 years, despite all of these conflicts, we've gotten up here to around 7,000. So the message here is that there are always going to be conflicts. There always have been conflicts. And the stock market, while it might have short-term volatility as a result, has always gone back to fundamentals. And as long as companies are earning solid profits, the market has gone up. We see this as no difference. Investing during these times of geopolitical uncertainty. So we've got all these various wars here, but the max drawdown. So again, during these conflicts, you can see big drawdowns. And then what returns of the S&P 500 were 3 months later, 1 year, and 3 years later. So just 3 months later, you're down 1%. So not a huge issue. Things tend to have very quick recoveries when we see these major impacts. And a couple of things to point out on this that kind of skew these figures. We've got the Russia-Georgia War of 2008. Yeah, that's not really even fair to put in there. That obviously had no impact on the stock market. That was the '08 great financial crisis. And then, the 3 year or the 3 month return was negative 27 on that. So you can basically take that out. You can kind of do the same with the war in Afghanistan in 2001, where it was down 33% initially. That was really as a result of the dot-com and internet bubble bursting. So there's a few in here that you could kind of take out that would only make these numbers look even more impressive. Because like the Russia-Georgia war, a year out, negative 19%, the war in Afghanistan, a year out, negative 24%. So if you strip those out, a year out, we're doing much better. And same thing, 3 years out, we're kind of almost getting back to just our average returns in the market. So the point is that the short-term volatility that these conflicts can generate, they are just that. They're short-term. And then generally speaking and historically speaking, we've kind of bounced right back. And ultimately, what drives the market, Bob mentioned it earlier, it's what are earnings. And currently, the earnings outlook, while the spike in oil, that dampers the outlook for like airlines who have high fuel costs and cruise ship operators as well. That has been more than offset by the increase in energy companies. And as we saw, we're generally net exporters of petroleum and related products. And then also tech companies have increased their earnings estimates in the last 30 days or so as well. So for the first quarter of 2026, earnings per share are expected to grow by 12.6%. For the calendar year of 2026, they're expected to grow by 12 to 17%. And so if we look at the annual returns when we're expected to get double-digit earnings growth, you can see all but 2 periods we've had pretty solid performance. I've had a couple of low returns here, but most are at double digits or meaningfully higher. To wrap things up, we pull this slide out quite a bit. It's the annual returns and the intra-year declines. So you can see these red dots here is the biggest intra-year decline. And while it is a pretty big average drop intra-year of 14.2% on average, we still have positive annual returns in 35 of the 46 years, which is about 75% of the time. Last year, for example, we lost 19% when tariffs happened. We finished the year up 16. This year, we were down 9 at our biggest peak. And while this says -5 through the end of the first quarter, we're actually positive now. So just always a reminder that short-term volatility does not mean we want to make any changes to the portfolio. Patience has always worked out for us in the long term. So with that, if you ever have any questions, feel free to reach out to your advisor at Traction. We're always happy to help. And we thank you for your time and listening to the first quarter of 2026 market and economic update. We appreciate you as clients very much. We appreciate your time, and we look forward to speaking with you all soon.